Welcome everybody, and today we will revise income from house property chapter. Super fast we'll try to recap everything in the least time possible. Chalo, what is income from house property? Under this head, if any income has to be taxed, there should be satisfaction of three conditions. That is given under section 22, that is charging section. First, there must be a house property. Second, it must be owned. And third, it can be used for any purpose other than business. Chalo, again recap. House property. What does this mean? House property means a building, appurtenant land there too, correct? That is house property. Second thing, it must be owned. Are you a registered owner? Legal documents are in your name. You are a registered owner. Or you may be a deemed owner. Still you will be considered as the owner. And it may be used for any purpose. It may be used for residence purpose. It may be given on a rental basis for businesses. But you should not do your own business. That is what section 22 talks about. So section 22 talks about three conditions. One, there must be a house property, it must be owned, and it must be used for any purpose other than business and profession. Own business and profession. Right? Now, if owner is giving the property on rent, it is taxed under income from house property. But if suppose tenant is giving, then it is called as subletting. If tenant is giving on rent again, that is called as subletting. It is not taxed under house property because primary condition is you must be an owner, correct? So that's why if tenant is letting out, it is called as subletting and it is taxed under income from other sources. Okay, some key important terms are there, like let out property. If the property is given on rent, we call it as let out property. If the property is occupied by the owner himself, we call it as self-occupied property. Hey, rent as per municipal valuation, right? Municipality, when it values the building, they create something called as municipal value. As a percentage of municipal value, some rent is fixed and that is municipal rent. Fair rent is something called as rent of similar building. In your locality, if you are renting out 2 BHK flat, what is the rent for 2 BHK flat nearby? That is fair rent. Standard rent. This is the rent fixed by the rent control authorities. This is the maximum rent which the owner can charge. Of course, this law is redundant today, but in income tax still it exists. Okay, so standard rent is the maximum rent which the owner can charge as per the Rent Control Act, and actual rent is what the owner receives from the tenant. Now understand that the properties are of two types: let out property, self occupied property. Now if the property is let out, then the income earned, let out means we are giving on rent, correct? The income earned is taxable. But if it is self-occupied, for what purpose? Are you occupying it for business? Then this chapter will ignore such property because that will be considered under profits and gains of business and profession. But if you are not using the property for your own business, that means you are occupying it but not for business. That means you are occupying maybe for residence, right? In such case, up to 2 self-occupied properties, no tax at all, completely exempt. But if you have more than 2 self-occupied house properties, then government considers the additional properties as deemed to be let out properties, and on that income is computed. And that's why maybe the authors say that under this chapter taxation is not on actual basis but on notional basis. MCQ question may be asked, right? Now come to the next part. If the property is held as stock in trade, right? Real estate agents may be buying, selling properties. Now for them, if the property is held for more than 2 years, then what will happen? Then they will be asked to pay the tax. Okay, I'll make you understand this in a better way. Simply understand, up to 2 self-occupied house properties are exempt. More than that, taxable. So real estate property owners have multiple properties, right? And if government says up to 2 exempt, more than 2 taxable, where these people will go? They are actually not earning rent, and if they are asked to pay tax, is it fair on them? So that's why government said no problem, up to 2 years we are giving benefit to you, we will not tax your multiple properties. But from the date when you get the completion certificate, building completion certificate, construction completion certificate, within 2 years they can sell the property or they can rent the property. But after 2 years, if they say it is vacant and government should not tax it, it is not possible. Even if it is vacant, government will consider it to be deemed to be let out property and income will be determined. Okay. But when I am talking about these 2 years excludes the year of construction. That means the year of construction plus 2, you remember. Okay. Up to that period, government will not touch the real estate owners' properties for taxing it as deemed to be let out property. Okay. Now, how to compute the income under the head house property? Very simple pro forma. You just see. First, we will take GAV, gross annual value. From that, we deduct municipal taxes. Third thing, when gross annual value minus municipal tax, we get net annual value. From these deductions under section 24, first one is standard deduction at the rate 30% of the NAV, and second one is interest on loan. And once we deduct these two items, we get income from house property. Chalo, recap with me. First one, GAV, gross annual value. From that deduct municipal taxes. We get net annual value. From that deductions under section 24. 24A, standard deduction at the rate 30%. 24B, interest on loan will be deducted to get income from house property. Now this is 100% true for let out property. That means you gave it on rent actually to a tenant. Or if it is deemed to be let out property when government considers it to be let out. Okay, it is not actually let out, but government considers it. When government will consider, up to 2 self-occupied is okay. More than 2 self-occupied properties, then the additional will be considered to be deemed to be let out properties. Okay, now self-occupied property is there. No GAV, no municipal tax, no NAV, no standard deduction, nothing. Only interest on loan is given as deduction. So in case of self-occupied property, only interest on loan is given as deduction. So what will happen? Of course, there will be loss as per house property. And that loss you can deduct from salary income or any other business income and save lot of taxes. That's why when people join the jobs, they try to construct the house and take a housing loan to save lot of taxes. Okay, shall we go forward? Now we discussed till now that we will take gross annual value, from that deduct municipal taxes to get NAV, from that deductions under section 24, standard deduction at the rate 30%, interest on loan, then income from house property. But how to compute this GAV? For that we discussed certain terms just now, right? That terms are useful. First, step 1, step 2, step 3. Step 1 says that take the higher of fair rent or municipal rent. So write what is fair rent given in the question. Write what is municipal rent given in the question. Compare the two. Whatever is higher, that is value as per step 1. That higher value compare with standard rent in the step 2. Here you will take whichever is lower. So higher as per step 1 or standard rent, whichever is lower. This is called as expected rent. Some books call it as reasonable expected rent. Okay. Once you get this, then in the step 3 we will value the gross annual value. What is gross annual value? Higher of expected rent as per step 2 or actual rent, whichever is higher. Okay, so how to compute GAV, gross annual value? Come on, repeat with me. Step 1, municipal or fair, whichever is higher. Step 2, that higher amount compared with the standard rent, whichever is lower, and that is called as expected rent. That expected rent versus actual rent, whichever is higher will become the gross annual value. This is how you should compute the gross annual value. Once you compute this, you have to deduct municipal taxes we discussed. correct? Municipal taxes are collected by actually municipality, town area committee, cantonment board, Mahanagar Palika, Panchayat, whatever name may be, right? They collect municipal taxes for local administration, and municipal taxes may be named as municipal tax, property tax, right? Or if you say local tax, anything is okay. But when can you claim the deduction for this municipal tax? If it is actually paid, when it is actually paid by the owner. Suppose if tenant paid, not allowed as deduction. Sir, if it is due, not allowed as deduction. Sir, arrears of municipal tax of last year's paid in current year, yes, it is allowed as deduction. Sir, current year municipal tax paid, allowed as deduction. Sir, advance municipal tax paid, not allowed as deduction, right? Advance municipal tax not allowed as deduction. Suppose we are in 22-23, our previous year is 22-23. Now you paid municipal tax in 22-23 for 23-24, 24-25, 25-26, not allowed as deduction in current year. But advance municipal tax will not be allowed in the year of payment, but will be allowed in the year to which it pertains. Suppose 22-23 is our previous year. You paid municipal tax for 23-24. So we can say it is advance municipal tax. So it will not be allowed when you paid, that is in 22-23, but will be allowed in 23-24 to the year which it pertains to. Okay, I feel you understood. Now, municipal tax sometimes may be given in the question as a percentage of municipal value. So just simply multiply it with the municipal property valuation and get the municipal taxes. Okay. So when they give municipal tax 6%, don't multiply it fair rent with fair rent or standard rent. Simply multiply it with municipal value of the property. They will not explain you all these things. You have to remember. Okay. Very good. Now how to actually consider what is unrealized rent? Come on, remember with me. We call it as unrealized rent if four conditions are satisfied. There should be an actual tenant who occupied the property. That means the property should be, the tenancy should be bona fide. The tenancy should be bona fide. The tenant did not pay the rent. The owner vacated him from the property. And owner tried all the steps to recover the rent but failed. Right? If these conditions are satisfied, what are they? Tenancy was bona fide. Tenant did not pay the rent. Owner vacated him from the property and the tenant is not in occupation of any other property of the owner. Not only that, but owner tried to recover the rent but failed to recover. In this case of unrealized rent, how the GAV should be computed? Again, three steps. Step 1, step 2, same, right? Fair rent for 12 months, municipal rent for 12 months, whichever is higher. Compare that with standard rent, whichever is lower. Standard rent also for 12 months. Okay. You get expected rent as per step 2. Then compare this expected rent of 12 months with actual rent of 12 months minus unrealized rent. Expected rent for 12 months minus actual rent for 12 months or annual rent minus unrealized rent. Whichever is higher becomes your GAV. This is how we will do in case of unrealized rent. Right? So is it unfair? Partially yes. Because if owner has not recovered the rent, he is unfairly taxed sometimes. But again, it is his inefficiency. So government is rightful in that. Okay, come to the vacancy part. Now if there is a vacancy, don't take GAV is equal to actual rent directly. Yes, most of the times it is true, but you have to follow this flow chart, correct? So suppose if there is only vacancy, still you follow this chart. If there is vacancy as well as unrealized rent, then also you follow this chart. What to do? Step 1 normal, fair or municipal, whichever is higher. Step 2 normal, that higher amount, or standard rent, whichever is higher. Step 3 expected rent for 12 months minus annual rent and oh 1 minute. So you will take expected rent as per step 3 and compare it with annual rent for 12 months minus unrealized rent minus vacancy rent. You get the actual rent, AR. I used the word. Once you get this AR, compare this with expected rent. What is higher? If suppose actual rent is higher, after deducting unrealized rent, after deducting vacancy rent, that means whatever you collected from tenant, that is actual rent. Okay, that actual rent is more than expected rent, then GAV is equal to actual rent. Simple as that. But suppose if expected rent is more than actual rent, then find the reason. Why? Is it vacancy the reason or other reasons? Let's find. So for that, what you have to do is you need to calculate one more word, that is notional actual rent, NAR. What is notional actual rent? Your actual rent which we computed till now plus vacancy rent is notional actual rent. Actual rent plus vacancy rent is called as notional actual rent. Now compare this notional actual rent with the expected rent. Compare this notional actual rent with the expected rent. If suppose notional actual rent is more, then GAV is equal to actual rent. I am not telling NAR, I am telling AR. GAV is equal to AR. When NAR is greater than expected rent, GAV is equal to AR. Okay, and if expected rent is more than the NAR, then GAV is equal to expected rent. So you have to remember these steps. If there is only vacancy, also do these steps. If there is vacancy and unrealized rent, then also you do these steps. Again repeating, GAV first step, second step, same. Like municipal rent versus fair rent, whichever is higher, same. Right? Then step 1 value, higher value, and our standard rent, whichever is higher, same. You get expected rent, but then you have to compare the expected rent with annual rent for 12 months minus unrealized rent minus vacancy rent. This is actual rent as per me. Okay, every book has some small deviations in words, so that's why I took AR. Okay, now if AR is more than expected rent, then simply GAV is equal to AR. If not, if expected rent is more than AR, then what to do? In that case, find the reason. How to find the reason? By calculating one new thing, that is notional actual rent. How it is calculated? Notional actual rent is equal to actual rent plus vacancy. Now once you get this, you have to compare the notional actual rent with the expected rent. If suppose notional actual rent is more, then GAV is equal to actual rent AR, and if suppose expected rent is more than notional actual rent, then GAV is equal to expected rent. This you have to remember like this. Now I already taught to you that how to compute GAV in different cases. From that, municipal tax related points over. Notional actual rent we got. Standard deduction, it is simple, 30% of net annual value. Yeah, net annual value. Simple, 30% net annual value into 30% standard deduction. That's it. But we have to understand that what is interest on loan, right? So let's try to understand what is interest on loan under section 24B. Hey, please remember that loan should be taken for purchase of, construction of house property, maybe repairs, renovations, right? For this purpose you should take the loan. For why? What purpose? Construction, acquisition, repairs, renovations, renewals. Only for this you should take the loan, right? The interest element is allowed as deduction. Now you can take the loan from family, friends, schools, banks, financial institutions, trust, anybody. It's your choice. Next thing to remember, that interest is allowed on due basis. If the interest is due, it would be deductible. Hey, municipal taxes when paid it was allowed. Interest on loan when it is due, it is allowed as deduction. Remember these words. Okay, right. Suppose if you delay in paying the interest and there is a penal interest charged, that means interest on interest. Is it allowed as deduction? The answer is no. Interest on loan is allowed as deduction, but interest on interest is not allowed as deduction. Penal interest is not allowed as deduction, right? Suppose sometimes what you do is, you took the loan from Bajaj Finance at 10% interest. Now because you paid for 2-3 years, now you are getting good offer from HDFC just at the rate 6%. You transfer the loan from Bajaj Finance to HDFC. In that case, on the principal amount which is transferred, right, and old loan is cancelled, new loan is created. On the new loan, whatever principal amount is there, on that principal amount, interest again will be allowed as deduction, right? So renewal of loan is okay, but principal should be shifted to new institution. On that principal, whatever interest is there, that will be allowed as deduction. And one more thing, please remember that if suppose principal plus interest is there, that is shifted to new bank, on the interest portion, again if you are paying interest, that is not allowed. On the principal portion, if you are paying interest, that is allowed. Simple. Next thing, if suppose you have taken the loan from foreign country and then you are paying interest outside India, so in that case government says please deduct TDS. So you are required to pay interest to the bank outside India, but from the total interest you should deduct what is the tax portion, and deduct the tax portion and deposit with the government. If you do that, then only total interest paid outside India will be allowed as deduction. If suppose you deducted the tax but did not pay to government, then also you will not get deduction of interest. Or if suppose you did not even deduct nor deposited with government, then also you will not get deduction. So if you are paying any interest on loan outside India, please remember, deduct tax whatever is fair as per the law and deposit with government, then only you will get the benefit of interest on loan as deduction. Now, okay, we understood what are the 6 conditions for claiming the interest as deduction. But there are further conditions. Suppose if the property is let out, then there is no limitation, entire interest paid will be allowed as deduction. If it is let out property, no limitation, entire interest paid will be allowed as deduction. But if it is self-occupied house property, then we divided it into 2 parts, special case and others. It says, did you take the loan on or after 1st April 1999? Did you take the loan on or after 1st April 1999? Did you take the loan for construction or purchase of house property? Did you take the loan for construction and completed the construction within 5 years from the date of taking the loan? If all the 3 conditions are satisfied, what are the 3 conditions? I am talking about special cases, okay? Loan taken after 1st April 1999. Second thing, for construction acquisition. If it is for construction, complete it within 5 years of taking the loan. Then maximum deduction you will get is how much? Maximum deduction you will get is 2 lakhs rupees. That means your actual interest or rupees 2 lakhs, whichever is lower, will be allowed as deduction. In all other cases, suppose loan taken before 1st April 1999 or loan taken for repair renovation or construction not completed within 5 years, in such cases, these are all covered under others, maximum deduction of interest is 30,000 rupees. So 30,000, how will we give deduction? Your actual interest or 30,000, whichever is lower. Your actual interest or 30,000, whichever is lower, okay, will be allowed as deduction. Simple as that. Okay sir, we understood. But sometimes what happens, if you are constructing the house property, you may have to take the loan before the house is ready. In that case, the interest which you pay till the building is ready, till the house property is ready, we call it as pre-construction interest. But because the house is not available, how can you claim deduction? You cannot, right? That's why government said that we will give deduction after the construction is complete. Okay. That means when you took the loan for construction of house, that means you took the loan before construction, right? For construction process. Can you get deduction when you pay the interest or when the interest is due? No. But when can you claim the deduction? Only after construction is complete. Okay. But we have to value how much is the interest. We have to calculate. For that, there are 3 steps. First thing, we should decide what is the pre-construction period. What is the pre-construction period? Pre-construction period is start date is there, end date is there. So please remember these 2 dates are there. Start date I am discussing. Okay. Start date is date of taking the loan or date of start of construction. Start date is date of taking the loan or date of start of construction. Start date is date of taking the loan or date of start of construction. Whichever is later. Please remember. So out of the 2 dates, whatever is the later date, that is the start date for pre-construction period. Now what is the end date? End date is 31st March. End date is 31st March. Okay. But 31st March, which 31st March? They said either 31st March before completion of construction or 31st March before the date of repayment. Right? If any one situation is there, construction is there, then you take 31st March before the date of construction. If repayment is there, you take 31st March before the date of repayment. But if suppose both are there, then what to do? Then out of the 2, what is earlier you check? Repayment date or completion construction date, whichever is earlier you check, and you take that date, and whatever that date is there, before that, if 31st March whatever comes, that is the end date. Once you decide the pre-construction period, then what you need to do? Pre-construction period into loan amount. Step 2 I am talking about. Okay, deciding pre-construction interest. So loan amount into pre-construction period into interest rate. Loan amount into interest rate into pre-construction period. Step 2 talks about what? Loan amount into interest rate into pre-construction period. Right? Once you get the pre-construction interest, in step 3, what will we do? Divide the pre-construction interest by 5. Why we are dividing it by 5? Government says we will not give pre-construction interest as deduction in one shot. We will give it in 5 equal installments in 5 years. Right? The year in which construction is complete, na? That year plus next 4 years. Every year equal portion will be allowed as deduction. Okay? That's why step 3. Pre-construction interest divided by 5. Sir, if pre-construction interest is given as deduction and the loan is not closed till now, can we get the deduction for current year interest also? The answer is absolutely yes. So you can get the deduction for current year interest and also pre-construction interest. But if it is let out property, no problem. But if it is self-occupied property, the total interest deduction is restricted, right? Up to rupees 2 lakhs or 30,000 as the case may be. Are you able to recollect what I said? Very good. Now shall we continue with the next point. Suppose example, you may be occupying the property. You have a building, 3 floors building. 1 floor you are occupying as an owner, self-occupied, and other 2 portions you have let out. So area wise it is partly let out, partly self-occupied. What to do? Consider each portion as a separate house property. Like one portion self-occupied, correct? So that is one house property. Two different portions are there let out, correct? Consider that as two different let out properties, two different properties. Then do the solution as normal. Self-occupied property portion, only interest will be allowed as deduction, others are nil. Let out portion, you will have rent, you will have municipal taxes, you will have interest, standard deduction, everything will be computed. Now you may ask me a question, sir, all things are okay, but what about municipal tax and interest? That is because municipal tax is for the whole building, interest on loan is also for the whole building, so that is allowed as deduction proportionate basis. So I said three portions are there, two portions are let out, so only 2/3 will be allowed as deduction for municipal tax respectively. Interest on loan also the same. If they gave fair rent, municipal rent for the whole building, then you only consider the let out proportion for computing the GAV. Suppose example, you may get in the question that 8 months it was self-occupied, 4 months it was let out. So this is partly let out time wise. Then what will we do? Simple as that, no need to worry, right? Government considers it to be let out property only, and your GAV will be computed as if it is let out for the period. So your fair rent, municipal rent, whichever is higher, for 12 months you will check. Your step 1 higher value and your standard rent compare and you will get expected rent. So expected rent is for 12 months only. But your actual rent, did you receive? No, correct? So whatever actually you received, that many months actual rent will be there. So expected rent for 12 months or actual rent, whichever is higher will become the GAV. Municipal taxes fully allowed, interest fully allowed as deduction. No problem with it. Okay. Now we understood this part also. Suppose example, you have in the question, they gave you actual rent, but they did not give you fair rent. Remember that your actual rent is equal to fair rent. Correct? Your actual rent is equal to fair rent. If fair rent is given in the question, no problem at all. You take whatever is given. But if it is not given, please remember your actual rent is equal to your fair rent. And all calculations will continue normally. Okay? Very good. Now, if you have more than 2 self-occupied house property, what to do? The answer is as simple as that. Suppose you have 3 self-occupied house properties. Then 2 will be treated as self-occupied and the third one will be treated as deemed to be let out property. In that case, you have an option. Which house property you want to consider as let out property and what others you want to consider it as self-occupied. Your choice. So when choice is yours, what will you do? Wherever the income is less, that option you will prefer, correct? So how will we know? By applying certain options. Like option 1 you take. House 1 self-occupied, house 2 self-occupied, house 3 deemed to be let out. Find out what is the net income from house property. Take option 2. House 1 as deemed to be let out, house 2 and 3 as self-occupied. Then see what is the net income from house property. Take option 3 again. House 1 self-occupied, 3 self-occupied, house 2 deemed to be let out. Now you see here how much is the net income. Wherever the net income is low, that option is best for you. And you have to write the conclusion also. Therefore, this option is considered. These houses are self-occupied and this house is deemed to be let out. You have to write. And please remember, even though your answer may be correct, if you don't write the steps properly, notes properly, explaining everything, then you will not get marks. So explain everything, every small step, write WN1, WN2, WN3 and give the notes accordingly. Okay. Now suppose there are other expenses like fire insurance you have done, building maintenance charges are there, lift maintenance charges are there, electricity charges are there, water charges are there, right? All these charges may be given, repair expenses may be given, legal charges sometimes are given. What will you do with this? Are all these allowed as deduction? The answer is absolutely no. So what we do with this? Nothing. Because government said cumulatively standard deduction at the rate 30% is given. So you can't ask for any other deductions. Pro forma is very clear, only that much deductions. Right? If in the question they give lift charges, they give water charges, electricity charges, fire insurance, building insurance, lift, don't be emotional, ignore everything. Okay. Now sometimes what happens is you recover the unrealized rent or you recover the arrears of rent, then it is an income, correct? So it should be taxed. How to tax? So recovery of unrealized rent or arrears of rent minus standard deduction 30%, and that becomes your income from house property. Suppose you recovered 1 lakh rupees, 30,000, 30%, 1 lakh into 30%, 30,000. It is standard deduction. 1 lakh minus 30,000, 70,000 income from house property. Now arrears of rent will arise because of the court dispute between owner and tenant. And unrealized rent, you know, tenant did not pay, tenant ran away, उसके अंदर का राम जग गया और उन्होंने आके वापस paid the rent, that is unrealized rent recovered. Now the question arises, what is composite rent? Composite rent is the mixed rent of building plus furniture and plant and machinery. If the rent can be separated, like building rent is this and furniture, plant and machinery rent is this, then building rent is taxed under house property chapter and furniture rent is taxed under, plant and machinery rent is taxed under income from business and profession or other sources. Right? Now, if the rent is one for building and house furniture, plant and machinery, it cannot be separated, then what to do? Then entire amount is taxed under either business and profession chapter or under other sources. Suppose one simple rule I will tell you, that if the assessee is a business entity and anywhere it is connected to the business and business is continuing, tax it under PGEP chapter. If the assessee is not a businessman, then simply tax it under income from other sources. Suppose example, hotel is giving not only the flat but also furniture, TV, AC, washing machine, fridge, everything, then it is business and profession chapter, right? But if suppose I am giving one flat of mine on rent with all these amenities at a single price, then it is income from other sources, right? This way you should be able to understand, because I am not doing business, correct? Now, what is co-ownership? Co-ownership means 2 or 3 people are together the owners of the property. We call it as co-ownership. Suppose father transferred the property to children jointly, then children become co-owners, or sometimes few friends together purchase the property, they become the co-owner. Then the question arises, what to do? Simple. Consider that there is no multiple owners and compute the income as we discussed till now, right? And once the income is derived, then what to do? Then simply, are their share fixed? There is a proper ratio? If yes, divide the income between them in the ratio. Okay, let them include their respective income in their income tax return. But if suppose the ratio is not fixed, in that case the group, the co-owners, are treated as association of persons. Clear? And they are taxed as an association. This is how co-ownership is. Now comes the question, section 27, deemed owner. Suppose example, transfer of property to spouse. The transferor will be the deemed owner. But suppose the spouse paid consideration, then the spouse receiving it will become the owner. Right? If suppose they are going to live apart, then the transferor will not be deemed owner. So when the transferor is deemed owner, if the transferor transfers it to spouse, he is a deemed owner. This is general rule. But if the consideration is paid, then transferor is not deemed owner. If they are going to live apart, then transferor is not the deemed owner. Then who is the deemed owner in these two cases? Who holds it? Simple, correct? Very good. Now, if suppose the property is transferred to minor child, then the transferor is the deemed owner. But if the child has paid consideration, then child is the owner. If child is a married daughter, then the married daughter will be the owner, but not the transferor, not the parent. Okay, very good. This is under section 27 clause 1. Holder of importable estate, section 27 clause 2. Now generally what happens is, the properties may be divided between brothers, but the temple, family temple cannot be, right? So temple is a impartible estate. The elder brother in the family will hold the temple, maintain the temple. So for the temple, he is deemed owner. Okay, the elder brother will be deemed owner under section 27 clause 2. Now, if you are a member of a company, cooperative society or an association, now these organizations are actually into house building scheme. That means they are constructing houses for their members and giving the members the possession rights of the house. That means legal ownership is in the hands of the company association, but the certificate of occupation, certificate of possession is given to the member. So even though the member is not the legal owner, registered owner, but he is deemed owner because he has the right of possession, he has the right of occupation. That's why deemed owner. Okay, this is section 27 clause 3. Now come to section 27 clause 3a. There is something called as I sold the property to Chhagan Lal. Now Chhagan Lal paid me all the money. I gave the property possession to Chhagan Lal, but the registration is not done. The legal title in the government records is not transferred to Chhagan Lal. So in this case, can we say it is part performance under section 53A of the Transfer of Property Act? The answer is yes. In this case, will I, the legal owner, document wise owner, be considered as owner, or Chhagan Lal be considered as owner? The answer is Chhagan Lal paid the money, he is considered as the owner. There is an agreement to sell with Chhagan Lal, so Chhagan Lal is the owner. Legally, document wise, he is not, but still substantially he is. That's why he is the deemed owner under section 27 clause 3a. And last thing, if the property is given on lease, long term rent, right, for how much time? 12 years or more, then we can say that the tenant, the lessee, is treated as the deemed owner. Now when I talk about these 12 years, it should not be monthly rent. It should not be a rental agreement for less than 1 year. It should be either 1 year or more. Original agreement plus extension period together, even if these two together also more than 12 years, that's it. Okay, the lessee, the tenant is treated as deemed owner under section 27 clause 3b. That's it. Clear? Any doubt? No. Last thing, exempt properties is one thing which we have to understand. Exempt properties means what? if particular list of individuals are there, if they hold the property, or organizations are there, if they hold the property, then even if they receive the rent, it is not taxable to them. That means to these 11 people or 11 organizations, house property chapter does not apply in simple language. Who are they? I said help cart. Help means H. H for what? Hospitals. E. Educational institutions. L. They are talking about residents of Ladakh. P. Political parties. CART I said. C for charitable institutions. A for local authority. E. R for scientific research institution. T for trade unions. Other than this 8, there is something called as farmhouse. There is something called as one palace of an erstwhile ruler. One palace of an erstwhile ruler. Right? And last thing, if the property is used for business and profession. If you are using for your own business and profession, then it is exempt under this chapter. Your tenant may be using for business. It will come under house property for you because you are receiving rent. But if you as an owner is using for business, then it comes under business and profession chapter, not here. So what are the exempted properties you remember? What are they? Patafat you tell me. H for hospital, E for educational institution, L for your residents of Ladakh, P for political parties, C for charitable institutions, A for local authority, R for scientific research institution, T for trade unions, then F for farmhouse, and I said finally that there is something called business and profession. If you are using for that property is used for business and profession, and there is something called as palace, one single palace of an erstwhile ruler. In all these cases, your property, or even if you are receiving the rent from the property, it is fully exempt. With this, we completed the house property chapter. I tried to quickly recap everything for you. Hope you enjoyed. Share this video with everybody you know, so that I also get some motivation and you get a lot of knowledge. Your friends will appreciate you. Thank you so much.